Well, look, I mean, I think more important than the current quarter, which actually was more or less in line, it's really the outlook that the company gave for 2022 being, somewhere around 200 basis points lower revenue growth than what I think the street was looking for. The street was looking for 17-ish to maybe 18%. They end up talking about 16 to 17% really now. And when you consider the new active users growth, they're really just talking about 15 to 20 million ads next year or in 2022 versus what I think a lot of the market would have looked to see over 50 million. So it definitely shows there's probably been a much bigger pull forward given the pandemic than I think a lot of analysts may have appreciated.
So you still have a outperform rating on this stock, $230? Is it? Are you buy? Would you be a buyer on this dip, or is it just more bad news that's justified?
Well, I think we're going to have to see how things trade in the next couple of days. But the reality is you got to keep in mind that even despite some of these nuances on what's most likely timing coming out of unusual times in the pandemic, this is a compounder growing 20% plus in a more normal time. And frankly, I think there's probably going to still be that consistency to their growth longer term. It's not that easy to find stocks trading at the multiples they're trading at with good free cash and that kind of growth. So we're going to keep an eye on how the stock trades the next couple of days. But certainly everything has a price, and I think if this dips to the levels it's looking after market, it could be an opportunity.
What sort of multiple is it on?
Well, right now, I mean, it used to trade at somewhere around 30 times pre-pandemic. It had reached 40 plus times earnings during the height of the pandemic, and then it's come back down to 30 again. Now it looks like after markets, it's trading somewhere in the mid-20s, which is lower than its historic norm by about 2 to 3 turns, which does look like it's attractive. However, you really have to understand what's happening from their conference call with regard to why they're guiding net new actives a level that's about half what the street really expected.
So what do you want to hear from them on that?
Well, I think we want to see if they're really going to underscore engagement growth rates and that they're going to be offering a lot more offerings and revenue opportunities such that, number one, even despite 15 to 20 million users, they're going to be able to confidently achieve their growth. Second of all, I think there's going to be a perception that the targets they're giving are very conservative. So investors feel like they missed numbers this quarter, they missed numbers at some point in 2021. Now I think investors want to see an opportunity for them to set the bar low and beat and raise consistently. That's what we're going to watch to see. And then lastly, we want to know if they can show accelerated growth beyond 22 versus what the sort of non-recurring one-time headwinds they're seeing this year. That's what we're really looking for, is the 23 and beyond trajectory.
It's been a rough ride for investors in this stock, and not a pretty after-hours session now, down almost 14%. Darrin Peller, thank you for joining us.